Welcome back, folks, to Investor Diaries. In the last video, we provided a bit of idea about what's going on in the market and some of the causes or drivers for this volatility. But what does an average investor do in this current scenario? How do you navigate this volatility? Let's find out in today's video.
Alright, so let's face it, losing money is an awful experience, and especially if you've got money saved up for a purpose like, say, retirement or buying a house or children's education. This actually is even worse.
That's right, Appy. The past few years have had very little volatility, with again the notable exception of March 2020. So this sharp reversal is going to be especially difficult for a lot of folks who haven't experienced this in the past. However, in a typical year since 1980, the stock market has declined by an average of 14% from peak to trough, with midterm election years having historically produced large intra-year pullback, 17% on an average according to LPL Financial. So, what are the strategies that you can adopt to navigate this market?
So the first strategy we would like to talk about is maintain your long-term focus. Over the years, those who actually commit to long-term investing, that is staying invested, staying disciplined, and focused on the long-term investment approach, they are actually successful. So this should be one of the plans as you are trying to navigate this volatile market. And you will realize that the market is going to reward you for this discipline and patience.
That's right. History has repeatedly shown it's not your timing of the market, but rather your time in the market that's a primary driver for investment growth. Volatility-induced stock declines, particularly in the face of otherwise strong earnings data, offer an opportunity for long-term investors to reduce their average share cost through dollar cost averaging.
So just a quick primer. Dollar cost averaging is when you invest the same amount of money in a particular security, but that's recurring over a certain period of time.
While extreme volatility may prompt investors to exit the market or sit on the sidelines for a bit, it's worthwhile to reconsider that strategy. A recent study by the investor research firm Dalbar examined the average return achieved by investors over the past 20-year period and found out that while most do try to time the market, they have significantly underperformed the market as a result.
So amidst very strong index returns, the average investor over that time period has underperformed a simple index, say indexed at 60 to 40% portfolio by 3.5% annually. So putting that in the context of numbers, on a $100,000 investment made at the beginning of 2001, this means that you would have missed out on more than $170,000 gains by the end of 2020.
Another point is that if you're focused on high growth stocks, do not change or alter it now. For example, if you had a portfolio of all Google stocks, and now you're worried about the tech sell-off amidst the volatility, and you also want to partake, you are going to lose. You should only sell A, if you're retiring soon and you need to save the cash, which we don't believe is most of our viewers, or B, if something has fundamentally changed about the company and you no longer have faith in the company and you want to exit the position altogether, or C, if you believe the price is going to go down even further, which means you plan to time the market and buy stocks at a lower price.
So we think a better strategy would be to stay the course, stay put, stay invested, stay disciplined, and buy in smallest packets possible. So what does this really mean? So as an example, you could actually consider buying one stock at a time if you've got access to something like a no commission trading.
So now a lot of folks might think, why don't we just sell now and then wait for the situation to stabilize? As simple as it might sound, such an idea is impossible to implement and poses a serious risk to investors' financial well-being.
As famed investor Howard Marks pointed out in his recent memo, missing out on just a few days could significantly impact or eat into your long-term return.
According to data from JP Morgan, during the 20-year period from 1999 to 2018, the S&P 500's annual return was 5.6%, a figure that dropped to only 2.0% for investors who missed out the 10 best trading days.
Investors who were unfortunate enough to miss those 20 days made absolutely no money at all. And the market's best days tend to actually follow its worst days.
Strategy number 2. Keep cash on your hand and pay off the high interest debt. While you can't control the markets, you can control how well you're prepared to navigate the turbulent water. Make sure you have an emergency fund set aside to cover at least 6 to 12 months worth of living expenses. This may help protect you from having to liquidate investments at a depressed value to generate needed income, and in return offer the ability to leverage a downturn's subsequently lower prices.
So if possible, pay down as much of your higher interest, for example, credit cards, say auto loans, debt. But this shouldn't come at the expense of tapping into your emergency fund. The simple goal should be to insulate yourself as much as possible from the financial stressors when markets turn volatile, so you are less likely to take impulsive reactions.
Now, strategy number 3. Don't put all your eggs into one basket. A diversified portfolio is the key factor in navigating volatility. Allocating your assets across a variety of investments would be definitely helpful and valuable in reducing risk. It starts with asset allocation, which is the act of dividing a portfolio into a variety of different assets such as stocks, bonds, and cash. Now, there isn't a set standard for how and where to allocate your asset.
Instead, it is actually unique to each investor, taking into account the key factors of the individual financial picture, such as the time frame that you have to achieve your goals.
And then from there, it's important to further diversify within each asset class. For example, if you're investing in bond market, your bond portfolio is not concentrated into one area. This allows you to be better protected during volatile times, minimizing risk if all your holdings are not in a specific security.
In addition, if you're actually considering converting some of your traditional IRA to a Roth IRA or TFSA or RRSP in Canada, a market downturn, that is when the value of your assets have been reduced, this may be an opportune time for a Roth IRA conversion, since the taxes you'll owe may of course be lower.
Strategy number 4. Rebalance thoughtfully. Over time, during a period of extended market gains, a portfolio invested in 60% stocks and 40% bonds, for example, might see its equity allocation steadily climb to 75%, while its bond holdings fall to 25%. And this primarily occurs due to stronger performance of stocks relative to bonds. This may cause you to take on more risk than you intended or need to based on your long-term goals.
There are several rebalancing techniques and strategies that can help us minimize potential tax calculations.
So some rebalancing strategies. First, think minimums. Consider setting a minimum threshold for rebalancing. This may help your portfolio to absorb some short-term market volatility without triggering purchase or sale transactions.
Consider the big picture. Don't look at individual portfolios in a vacuum. And even if the target allocations in your taxable portfolio drift beyond acceptable risk limits, they may be offset by a simple reallocation of your assets within your retirement accounts without any tax impact.
Be strategic about your RMDs, which stands for Required Minimum Distribution. If you're 72 or older and taking RMDs or required minimum distributions from your accounts, you may be able to rebalance by drawing down from your more profitable investments.
So like everyone else, we are concerned about the recent stock market volatility. How can anyone not be? There's no sugarcoating around it. Volatility is a very tough period for every investor alike. But at the same point of time, think about it this way. Corrections are an integral part of the whole investment life cycle.
Without these corrections, stock pickers like us would have no chance to purchase stocks at a deeply discounted levels. It is the volatility that gives us the potential opportunity to generate superior long-term returns as compared to other types of investments.
So we hope that you found these strategies useful.
And during this course, if you have any questions or comments about the strategies, or there are other strategies that you think are useful and you've deployed it successfully, do let us know in the comment section below. Until next time, stay tuned, stay focused, and embrace the volatility.